Are you ready to maximize your savings while preparing for education expenses? It's honestly one of the absolute biggest financial goals for families out there, and yet, year after year, so many people just leave money on the table when it comes to state-sponsored benefits. Well, today, we're changing that. Stay tuned as we unveil everything you need to know about claiming the Indiana 529 tax credit. In this explainer, we're breaking down this highly lucrative benefit. Whether you're a parent, a grandparent, or really just planning for a loved one's future, we are going to walk through exactly how to turn your everyday savings into direct tax benefits. All right, let's dive right into our roadmap for today so you know exactly what's coming up. Number 1, the Indiana 529 Advantage. 2, calculating your tax credit. 3, eligibility and plan rules. 4, filing schedule IN 529. And finally, number 5, plan partners and features. Okay, let's kick things off with Section 1, the Indiana 529 Advantage. We're talking about some seriously powerful tax benefits for education here. So there is this huge misconception out there that 529 plans are just locked away strictly for traditional four-year universities. But the reality, it's way more flexible than that. You can actually deploy these funds for a huge variety of qualified educational expenses, up to and including Indiana K-12 tuition. But here is the real magic. Your savings grow tax-deferred. That basically means your money compounds much faster over time because, well, you aren't paying taxes on that growth year after year. It allows you to build up a significantly larger safety net compared to just leaving it in a standard taxable savings account. Moving right along to Section 2, calculating your tax credit. This is where we maximize those state benefits. Okay, the crucial point here, the thing you absolutely must remember, is that Indiana taxpayers receive a state income tax credit equal to a whopping 20% of their contributions. To put that into everyday perspective, for every single $100 you put into the account, you are effectively getting $20 right back on your state taxes. It is literally an immediate, guaranteed 20% return on your investment in the form of tax savings. Now, there is a cap, and that absolute maximum annual credit is $1,500 for single individuals and married couples filing jointly. Because the credit is 20%, if we do the math, it means you need to contribute $7,500 in a given tax year to capture every single dollar of that maximum benefit. Honestly, it stands as one of the most generous state tax credits for education savings in the entire country. It's an absolute cornerstone for long-term financial planning. Actually, quick heads up here for your overall tax strategy. If you are married but filing separately, your maximum credit limit is halved down to $750 annually. So you really need to factor your specific filing status into how you plan your household contributions. Couples, definitely coordinate carefully here. You do not want to inadvertently overcontribute past your personal cap and miss out on optimizing those benefits. Let's jump into Section 3, eligibility and plan rules. You've got to know the requirements to play the game, right? Eligibility is super broad. Single filers, joint filers, and, since 2019, separate filers can all participate. You just need to be a U.S. citizen or resident alien over 18. But here is the truly fantastic part. There is 0 state residency required to open an account. So say you've got a grandparent living in Ohio, they can absolutely open an Indiana 529 for their grandchild. Now, while only Indiana taxpayers can claim that 20% state tax credit, the broader tax-free growth benefits of the plan itself, those are totally accessible to anyone, anywhere. Before we go any further, let's lay down a couple of basic ground rules. The state gets pretty specific here. The account owner is the one who holds all the power. They pick the beneficiary and control when and how distributions happen. And as for a contribution, to qualify for that sweet tax credit, it literally has to be a cash deposit made specifically for the student. You cannot roll over existing stocks, mutual funds, or other non-cash assets and expect to claim this specific state credit. It's got to be fresh cash. Okay, pay super close attention to this one because it's a huge caveat. The 1-year holding rule. The state essentially requires your account to have some longevity. If you try to, game the system by opening an account, immediately claiming the tax credit, and then closing the whole thing just to pay a tuition bill the very next week, you are going to face penalties. The account must remain open for at least 1 year, or the state will just recapture that tax credit right back out of your pocket. Getting started is honestly incredibly accessible. It takes a minimum contribution of just $10. That's it. You absolutely do not need some massive lump sum of cash to begin building this safety net. The single most important strategy in all of long-term financial planning is simply to start. Capture those valuable tax advantages early and let the magic of compounding interest do all the heavy lifting over time. All right, Section 4,
Filing Schedule IN 529. These are your step-by-step tax instructions. When tax season rolls around and it's time to actually get your money, this workflow is the precise, non-negotiable order you have to follow. A super common mistake is trying to jump straight to the 529 form. You just can't do that. The math literally requires the first 8 lines of your main Indiana Form IT-40 or IT-40 PNR to be totally locked in before you even touch Schedule IN 529. When you are filling out that Schedule IN-59, be sure to clearly separate your higher education contributions from your K-12 contributions. They actually go into completely different columns. And oh, here is a massive hidden gem to look out for. There's a dedicated checkbox for if you made a contribution but do not actually own the account. This is a real game changer. It means an aunt, an uncle, or a family friend can deposit money directly into a child's fund owned by the parents, and that contributor can still claim the 20% tax credit for themselves on their own Indiana state taxes. How cool is that? One crucial piece of advice: do not get caught out by the clock, especially during that frantic holiday rush. To count for the current tax year, your contributions absolutely must be received before the New York Stock Exchange closes at 4 p.m. Eastern Time. If you wait until, say, 5 p.m. on New Year's Eve to hit submit, well, that contribution rolls into the next business day, which means you just lost the tax credit for the year you actually wanted it for. Finally, let's wrap up with Section 5, Plan, Partners, and Features. We're talking trust and management here. Knowing exactly who holds your money brings some serious financial peace of mind, right? Well, the program is officially administered by the Indiana Education Savings Authority, which gives it rigorous government oversight. Meanwhile, a census acts as the dedicated program manager, making sure all the day-to-day operations run securely and smoothly. And your capital? It's in highly capable hands. They utilize a multi-manager platform that features world-renowned asset managers. We're talking heavy hitters like Vanguard and BlackRock's iShares. This guarantees you aren't just letting money sit in some static account. You're actively investing it with access to professional, customizable portfolios that are specifically designed to outpace inflation and hit those long-term savings goals. Now, as required, I need to remind you, this video is for informational purposes only. Please consult a financial advisor or tax professional for personalized advice pertaining to your individual circumstances. But I'll just leave you with this final thought. Every single year you delay opening an account is another year you pass up a guaranteed 20% return on your state taxes. If you knew you could instantly turn every 80 cents into a full dollar for education, honestly, what's stopping you from starting today?